Everyone, Logan Hertz here with Hazeltine LLC. We got back our man D'Andre Clayton of Clayton Financial Solutions. D'Andre, how you doing?
I'm good, my friend. How you doing today?
I'm doing well. I'm doing well. So today I thought we'd talk a little bit about some of the elements of whole life insurance that are difficult to quantify. So first of all, two different things, the infinite banking concept and whole life
Mhm,
insurance. I always want to make that distinction because
mhm,
that in itself is one of the problems with whole life insurance is that there's so many different ways you can design it and so many different ways that you can utilize it. And when people say it's terrible, they're looking at the product, they're not looking at the strategy. You can
mhm,
look at a piece of real estate and it could be a great place to live in, but maybe a terrible investment. It could be great as a fix and flip, but terrible as a long term buy and hold rental. There's all kinds of different things that could be going on. So with whole life insurance, we always have to be careful in being too focused on the product. And that is the number one most important thing about whole life insurance is that oftentimes it's not the policy itself, but how it makes everything else about your financial picture so much better that makes it so great. Chris Kirkpatrick calls whole life insurance the BASF for financial tools. It's not what it does for itself, it's how it makes everything else about your financial life better. So, just to give one little example, one of the things you have to account for is when you take out a whole life insurance policy, that gives you some death benefit. That means you're paying less in term. So, not captured in the policy itself is the savings you now have on a term policy
mhm.
that you would have had to pay for otherwise. And there's so many things we could look at. But DeAndre, why don't you give us your general understanding of that and maybe start talking through some of the benefits of whole life insurance that are harder to see or the ones that are obvious? We can start with those maybe.
So, probably one of the most obvious things is the tax savings. And I believe it's understated when we talk about whole life insurance. So, me being an IRMA guy, I remember when I was going through the certification for it, like the things that it said does not count towards your modified adjustable gross income, life insurance loans, reverse mortgages, HELOCs, and Roth IRA, and HSA if you use it for health purposes. So most of the time with traditional financial advising, it hurts a person on the back end of their life. It feels good in the moment, maybe. Certainly not right now, but it may feel somewhat like, hey, I'm doing something that is good for me. And then in the back end, it's like, hold on, what is this? I wasn't expecting all these problems to come about in my senior years where taxation changes based on the other things that I have going on. So I would say probably taxes is the number one thing. The other thing is when you're talking about return of investment and investments, that's the only viable metric to people. And it's because there's nothing else that the money is expected to do. And it doesn't do it in an effective way. I'll probably recall one of my favorite videos from you was about how investments make terrible insurance. That was a fantastic video. I think it was mutual funds make terrible
Yeah,
insurance.
yeah,
So
yeah.
when we think about whole life insurance holistically, a person saving or investing up to a point that it could cover all the aspects that life insurance would cover, they would have to make a ridiculous return. And I put it in this sense that the death benefit itself, if we were using an ROI calculation, it is far more than any ROI you could earn in an investment, unless you're talking about Bitcoin from the early time. Right? And so, because of that, it's like, okay, that can help with things that Medicare won't pay for in your latter years from a health benefit standpoint. There's this 80/20 hospital medical, but there are things that Medicare won't take care of. And a lot of that is holistic care and so on and so forth. Life insurance can completely fill that hole without you actually saving the money that would normally equate to being able to grow such a nest egg to do it. I will say that's probably one of the number one things. Taxes is great. The other aspect would be credit protections. Now, I know when I say this for all of those fiduciaries, you're going to say, in about two or three states, there is no credit protection or there is a difference. And
And
if
they'll
you,
say it in exactly that voice. It'll
you
sound
know,
exactly like
every
that.
time. when I see them type, that's how I hear it. I look for worst case scenarios.
It's
And
a
so
programmed response. It's a bots.
programmed response. And so to me, that's another wonderful benefit is that life insurance policies have this built-in umbrella insurance into them over the cash value, which is a very nice, unique thing that is not necessarily over other asset classes that you would have. And then we have the emotional aspect, which of course is my number one thing that I focus on, is the psychology of having something that is not based on hypotheticals from a up down up down up down perspective. And I use that based on hypotheticals up down because what some will say, once again in the nerdy voice, but the dividends are non-guaranteed. They won't say that the dividends have been declared and paid for 177 years. They'll just say that it's non-guaranteed and try to make it seem as
Right.
though
And then in the same sentence, they'll say, "Oh, and put all your money in this market asset where nothing is guaranteed at all."
nothing's
Right.
so. To me, I think those are the key points or the key tenors where I look at life insurance as a foundational asset because you're able to have a peace of mind. And I want people to understand in general, when I talk about peace of mind, I talk about something that can't be measured in ROI. You could have a ton of money, but that doesn't equal a peace of mind. That doesn't make
Yeah,
you
and let
just
me let me just stop you there for a second. One of the things that Glenn Yaney said that I think is very accurate is that having whole life insurance enables you to make better financial decisions. It's hard for people to understand this until they're in it, but when people lay out financial plans on paper, it might be achievable on paper, but when you're in it, it's very difficult to actually execute on it when things are happening in your life. When you have the peace of mind that whole life insurance gives you, where you have this store of liquidity, this safe asset, this savings, this foundational asset, you will make better decisions. And therefore, everything else about your financial life will get better. And that's not anything you can show in an illustration or with numbers or in a plan because it's a psychological benefit, but you will make better decisions. And this is coming from a guy who's a pretty sophisticated real estate investor. He buys mobile home parks. So I think his ability to execute on a financial plan would be pretty high. And he's acknowledging that whole life insurance is giving him the peace of mind to make those decisions. So ironically, these investment plans that are oftentimes proposed as alternatives, if those people who are doing those investment plans had capital and whole life insurance, they would be better able to execute on those plans.
yeah, it's an emotional IQ thing. When I'm training an agent, for instance, who enters the industry, I tell them don't go too high and don't go too low. Yes, there's going to be
Easier said than done. Easier said
it's
than done.
it's definitely easier said than done, but it's so necessary to be successful long term in this industry. If you get a good client and you make a lot of money, then if you went too high, you're not going to be inclined to continue working. So you're going to go right back down because you went on vacation, you blew all the money, you enjoyed yourself. Whereas if you go too low when a client denies you or you can't overcome certain obstacles with particular clients that you may have spent some time with, then you're going to miss all the opportunity of the people that you were too depressed to speak to. And so life insurance is very similar from an emotional standpoint. It makes you a more anti-fragile because it's such a utilitarian tool that you can assign purpose to the dollars as opposed to assigning purpose to investment dollars is extremely difficult. And this is
Yeah.
this is something I didn't realize until very recently. I came to this recognition maybe even a week ago where I was with a client and we were talking about an annuity in particular. But when we talked about the annuity, I talked to them about locking in the amount of money that they need as cash per year for the rest of their life. And the one thing that they asked me that was really interesting was what would be the interest rate that I would expect to grow on a regular basis? How much could I earn here? And I said, let me ask you this question. what would you prefer, to be guaranteed that your family is going to make $100,000 a year no matter what, net? Or would you prefer to know that there's a possibility of you making 22% in a year, but you could also lose a lot of money too? And he said, I would prefer that we net $100,000 every year. And I said, okay, so why did you ask me the question of how much interest could it possibly grow? Because his mind is trained to believe that return on investment is so important, but he doesn't know why.
Hypothetical, hypothetical return on
Hypothetical,
investment.
right?
Because if you got a
Hypothetical.
guaranteed return like in whole life insurance, that's a totally different story because now it's
Yep.
reliable.
Yep. And so with that reliability, now you can actually assign a purpose to it because you know it will be there. Whereas with the unreliability of an investment, you can't really say what you're going to do with it. And I've
Yeah.
found that to be the case quite often.
Yeah. That leads me to another point, which is the policy loan feature. So I love what you said about assigning a purpose to it because
Mhm.
people put money into an investment account, a retirement account. And the question is, what's the long term plan? To your point, how are you going to use that money?
They
And the
don't
answer
know.
is they haven't even thought that far ahead. It's just sitting there and it's doing one thing for them, hopefully earning a return. But you
Right.
don't benefit from that at all until the money's in your pocket. So when are you going to sell and what are you going to earmark that
Mhm.
money for when you sell it? That's the
Yep.
question. And there's a big opportunity cost for doing that because when you sell, you lose all the benefits of having that money in an investment. You lose that hypothetical return. Whereas in whole life insurance, you can use the money without interrupting the growth in the policy. So even if we grant that this investment account is going to grow at whatever projected return you want to hypothetically say 8%, whatever it is, if you want to use the money, you have to withdraw it. And now you interrupt that earnings and you lose all the potential earnings on that money you withdrew. And if you interrupt it early, as oftentimes happens because life happens, you interrupt it. Whereas with whole life insurance, you can take out a policy loan with borrow against the policy with no repayment terms, and you did not interrupt the growth of that policy at all. So whole life insurance makes a great financing tool because unlike anything else, when you use it, you're not interrupting the growth in the policy. And to repeat something D'Andre Clayton said earlier, we've been in the business long enough. And you don't have to be in the business very long to say all these things you think of as if situations are when situations. At some point, probably more than once, you're going to have a large unexpected expense. At some point, you get diagnosed with cancer. Your spouse has a heart attack. Your child has some issue at school. You get hit with a frivolous lawsuit. Take your pick. Your house gets damaged and insurance won't pay for it. Take your pick. There's any number of things, probably at least once, probably more than once, that will happen to you at your life. If you have whole life insurance, you have a safe way to keep your financial plan on course.
Absolutely. Absolutely.
So the
Yeah.
policy loan feature, that's another one that it's very difficult to illustrate the benefits of that you can use the capital without interrupting the projected growth in the policy.
Mhm. Yeah. That feature right there, as you mentioned, it is impossible to correctly illustrate just how valuable that is. But I'll use an analogy for people to maybe get them a little bit closer. The benefit of recycling. Recycling allows you to throw away a bottle into the recycling bin and for it to be repurposed into something else that is far more valuable than the bottle you threw away. And that recycling allows value to change for this particular thing that you are actually recycling into something that just grows into something special for you. America, or even companies, because I remember this was like a big thing when I was working in corporate. They would always have these situations with the yellow belt and the Sigma. But one of the main things that they would do is try to minimize waste by recycling everything that they do. And that would change their profit margins because it was no longer waste. And they were able to recreate it so that it actually did bring them profit. You can't recycle investment money. You just can't recycle it. That's not how it works. You use the money, it's done, it's over. Whereas when you have money inside of a life insurance policy and you take a loan against it, you're effectively recycling money. So you've got the money still growing in the same place that it was growing. You pay back the loan, but by the time you pay back the loan, it is now a more valuable asset than it was before when you took the loan. So there's some natural things that are going on there that if you were to try to compare that to a ROI, it's extremely difficult because an ROI, I don't want to say an ROI is linear because it's not at all, but the loss of an ROI is more linear. That's finding out what you actually made in ROI.
Yeah, it's most likely to happen when the market is down. So imagine you are contributing to a market account, the market crashes, and you have to withdraw $50,000 from your market account at that time when the market is down. And then you slowly maybe recycle it back in over the next 5 to 7 years, maybe if you do that at all. You'll see the impact to your long-term result is dramatic because you cannot get those years back. If you have a whole life insurance policy protecting you, that $50,000 loss won't be there because you'll be borrowing against your policy. And so you could see what that would look like. Let's talk about another thing that can interrupt people's plans, disability, which doesn't necessarily mean you getting into a car accident. Usually it's illness. So there's about a 1 in 3 chance of you having a critical illness at some point in your life, heart attack, stroke, cancer, something like that. Could be a number of other things. But it could also be just being unable to work for whatever reason for a certain period of time. On a whole life insurance policy, it's very easy to add. There is a cost to it, but it's pretty minimal. Disability waiver premium. So if I'm contributing a significant amount of money to my whole life insurance policy, and then I become disabled and unable to work, the insurance company will continue my plan for me. They will keep
Right.
paying those premiums for me. If I'm contributing to these other assets and I'm disabled and unable to work, nobody steps in and helps me and does it for me. What's the benefit of that? How do you quantify that, D'Andre?
You can't.
Plus the peace of mind. Think of that again. This all
I
comes back
mean,
to the peace of
you
mind.
can't you
Yeah.
you can't quantify that because it's something that when you're dealing with average people, it feels like they always are in a hunter position where you have to recreate over and over and over and over again to stay at the same status. But something like disability insurance, it gives you the peace of mind to know that if I got injured on a hunt, I can still eat. And I believe that people have minimized why that's such a good thing. That we know that we go out in the workforce, we work as hard as we can, but health is fickle. We could be the person who works out to the best of our ability. We could eat to the best of our ability, but we are in a situation where naturally we will have health conditions that will occur. So when that happens, not
Not the
if.
people I'm talking to, DeAndre, the people I'm talking to are gifted with invulnerability. So they don't need these
Oh,
crummy insurance policies.
but in it,
Seems like everyone I talk to, they're gifted with invulnerability. So I don't know. Life's just not fair. I wasn't gifted with invincibility, so I got to buy these crummy insurance policies. Life is so unfair, man.
oh my bad, that's true. Yeah.
Nobody believes me. Nobody believes me, but it is possible that suspend your disbelief. It is possible something negative could happen to your health. And people will
Right,
say, I know that's possible, but don't make me spend a dime. Don't
right,
make me spend any money. As soon
right.
as you make me spend money, I'm out. I'm out.
Yeah.
Yeah. But
Yeah.
then they'll spend money on eating out. They'll spend money on all sorts of other garbage that they don't need. But they're
I know
not
what
going
you
to.
think. 'Cause you like coming for me. You like coming for me, so I'm just going to do it. Gonna say
See,
they spend
DeAndre
money
can
on.
afford that. That's the difference. Yeah. So again, offense wins games, defense wins championships. The Moshe Milevksy study showed that it's more important to eliminate or minimize losses than it is to maximize gains. And the fact that we're even talking in terms of gains and losses shows we're already in the Wall Street cartel. We've already
Right.
accepted that risk is necessary. No, taking on risk is not necessary. Why are we talking about losses to begin with? You don't have to put your money into the Wall Street casino. Nowhere is it written that that's required to get wealthy. The people I know who got wealthy didn't do it in the Wall Street casino. If you want to play that game, you can, but understand you don't have to. And if you do want to play that game, whole life insurance will help you to play that game with more discipline and more patience and longevity because you'll have this foundational asset. But the Moshe Milevksy study showed that over the long run, if you eliminate the best years of the market, but you also eliminate the losses, you end up better off than if you have full exposure to both, where you're fully exposed to the ups and the downs. So no one wants to talk about losses or negative events. But when you talk about people who where things did not work out financially, it's almost never, oh, the market didn't perform like I expected, or all my investments didn't perform like expected. No, it's some negative event happened to them that they were not prepared for, that they could have been protected against with more preparation. Maybe if they had had a liability insurance policy in force, maybe if they had had whole life insurance in force, the right protection in place. And then that puts you in a psychological state of mind where if you want to take on risk and invest your money, now you can do it with more safety. So, ironically, these investment plans that they think are competing with whole life insurance, which they're not, those actually work out better if you do have whole life insurance first. So in my recent video, Buy Term and Invest the Difference, I show my framework where it's protection at the bottom, then savings, then investing, then speculating. And what I'm showing is that Buy Term and Invest the Difference skips the step. You buy term life insurance, that gets you protection. That's good. And then you invest money. Wait a minute, you skipped savings. You need to build some savings first. So go ahead and buy the term life insurance. Term life insurance and whole life insurance are not competing with each other. Buy convertible term life insurance with a good mutual company that has a competitive whole life product, and then take that difference and start putting it into whole life insurance as a savings vehicle. Then, once you have that foundation built, then go and invest your money. And now you can do it with more safety and stability.
Absolutely. Absolutely.
How about the permanent death benefit protection? People compare death benefit in whole life to death benefit in term like it's the same thing. No, it's not the same thing.
No.
That's like saying the guy who lives in a $500,000 house and owns it and the guy who rents a $500,000 house is the same. No, it's not. No, it's not. He might live in a $500,000 house, but he's just renting it. He doesn't own it.
Yeah.
If you have a term life insurance policy, you're just renting that death benefit. Own it. You own nothing. Not that term is bad, it's just it's temporary. That death benefit is not going to pay out, hopefully. In whole life insurance, you own that death benefit. It is yours. It is yours. So one of the things that I'm sure you hear a lot, D'Andre, is, yeah, when I'm retired, I don't need life insurance, man. D'Andre, you've done a lot of work with Medicare and retirement. What do you think about people who have permanent life insurance versus people who don't when they retire, when they get old? What's the difference?
Oh man. One, when they actually get to that point, they never say that. So that's number one. That thought process is something that a younger person who is optimistic and feel like they're Superman would say about when they get older because their mindset has not matured to the fact that life does change and effects on their body is completely different. Those who are older, I have not ran across a person who was happy about not being insured anymore. Not one. I've never ran past a client who was like, man, I sure am happy I never bought life insurance. Or I sure am happy that I only had term. I've not ran across one in my entire career of the last 10 plus years. So that analogy is something that is theoretical. It's a hypothetical. And that hypothetical is based on being very optimistic about what their returns will be in the market. But those who, especially the richer they get, the less likely they are to value the wealth they have if a life insurance policy is not in place. So it's a catch 22 because people believe that you can out invest the need for a life insurance policy. But if your value grows that much, you're going to need something to settle your estate.
Yeah,
I'm
so
like,
that's another thing too, is this is more for higher net worth clients, but of course, a whole life insurance policy is massively important for estate planning, right? It
And
is
on
a
top,
phenomenal and very efficient estate planning tool.
absolutely. And on top of that, I think what a lot of people who might be high earners right now, not necessarily wealthy, but they may not understand that if I were to pass, one, I'm still putting handcuffs on the money that I'm handing to my family because they get inherited IRAs now. And there's rules associated with inherited IRAs. There's a 10-year rule on them, whereas the life insurance would just pay out. Now, granted, you could set it up structurally if you want the life insurance company to release portions of the death benefit, that's fine. But at least you're not dealing with taxation. At least you're not passing a 59 and a half rule on the money that you left for your family. So that's another thing that a lot of people haven't really taken into consideration as well.
Or you can take out whole life insurance policies on your children and your
Hmm.
grandchildren and pass that on to them.
Yep.
You can use a trust or you can hand it on to them directly if you think they're responsible enough to handle it. That's what the Rockefellers do. And you don't have to worry about any of these limitations or rules. It's a very, very efficient means of transferring wealth to the next generation with no hassle, no lawyers' fees, no paying taxes. They don't have to manage it. It's not like real estate or investments. Because the other thing about investments is they have to be managed. There's risk. Same thing with real estate. So it's
Hmm.
not like you giving them cash, whereas a whole life insurance policy is you giving them cash. Doesn't need to be managed. There's no headache. How about the value, DeAndre, of the long-term care protection that is included in whole life insurance policies, where you can, if you late in life, by the way, the odds are 70% if you're
Yeah.
married and you reach the age of 65, that you or your spouse will have some form of long-term care need before you die.
Yeah.
How about the value of knowing you can use that death benefit for long-term care should you need it?
That's super valuable in whole life, especially when it's mutually designed, because I think what people have not realized about mutually owned designs is that the death benefit is also being pushed by the dividend as well. So
Right.
when you have
Right.
a long-term care benefit, that long-term care benefit is actually growing because of the dividend pushing the
Correct.
death benefit. Well, and from a standpoint of the initial value, technically it would be higher than getting a standalone long-term care initially, right? Now, if you got a standalone, you might grow into it being valuable or more valuable than the long-term care at the end. I guess you could say that that's an idea. But at the starting point, if the long-term care is promising me 36 months of $9,000 a month, $12,000 a month, on the rider of the life insurance policy day one, that would typically be better than working your way up to have that level of benefit inside of a long-term care policy standalone originally. So you got to put a lot of premiums in there over time.
And let's be honest, DeAndre, most people don't do any of this. They don't
Right.
have a long-term care insurance policy. They got nothing, nothing at
That's
all.
true.
Um,
That's true.
and so this is better than nothing. And I would say the beauty of it is if you take out a whole life insurance policy and you're just interested in the cash value accumulation and liquidity, that's great. But as you age, you're going to start to appreciate the fact that you have long term care protection. You're going to start to appreciate that you have this death benefit legacy. What it does is someone who is very young and maybe not as focused on those things still gets those benefits and they grow into appreciating them. Whereas the average person, they don't start thinking about long term care till they're 65. And at that
Right.
point, are you even healthy? And if you are healthy, there are options, but they're going to be a lot more expensive. Whereas the guy who took out a whole life insurance policy because he wanted to do infinite banking and he started at age 35, he's got millions available.
On a young person, that
Uh,
rider is probably a couple hundred, $300 a year. It's not.
well, and so DeAndre's bringing in even more nuance. I didn't want to get into this much nuance, but you can get a whole life insurance policy, the sort that you would use for infinite banking, which has a chronic illness rider where you can advance yourself to death
Mhm.
benefit. You can also get a whole life insurance policy with a true long term care rider that qualifies as long term care insurance. And that would be even more robust. But for the purposes of this conversation, not as much talking about that, but it just shows how whole life insurance is so actuarially sound because they
Right.
know how to underwrite that permanent death benefit. That so many
Yes.
different insurance policies are being consolidated into it.